Good morning, everyone, and thank you for participating in today's webinar. We've had overwhelming inbound interest on this deal, and today we have hundreds of participants pre-registered for the webinar. The format today is I'll give a brief presentation on the Petrojarl, followed by questions. I'll try and keep it brief, so we should have ample time for questions. So what we've announced is that we've entered into agreements to acquire the Petrojarl, which will be deployed to our Kuda Tasi and Jahal fields offshore Timor-Leste. And in fact, we're looking at completing the transfer of the vessel in the coming days. So this is a big occasion, not only for Finder, but for the project, for our partner, Timor Gap, and Timor-Leste. It's a major piece of the production infrastructure. You can see it here, over 700 foot long, 35,000 tonnes of steel. So this is a big de-risking event for the project and a major step forward for Finder. I think if there was anyone left doubting whether this development's going ahead, I think this step has put those doubts to rest. So let's get into the detail. Look, what you see here is how we look at the steps to FID, and we've made significant progress now and rapidly. You bear in mind, we've only been on title for 12 months here, a little over 12 months. So we acquired the asset, the PSC, in September of 2024, and since then we've had a series of major de-risking events, value-creating events. And let me talk through some of those, and I'll start with the subsurface. Now, we were very fortunate, I think, to inherit a project where significant drilling had taken place to de-risk the subsurface. Just in Kuda Tasi and Jahal alone, we have 5 well penetrations, we have logs, we have cores, and we have a flow test in each of the reservoirs. You're demonstrating flow rates of above 20,000 barrels of oil per day per well. And looking, of course, at a 3-well development here. I think it's rare for a junior like Finder to step into an asset that's so mature, where all the heavy lifting's been done from a risk capital point of view. And really, we've stepped into a project that has a rapid path to production and cash flow. It's a greenfields project. It's not like we've acquired a late life asset with limited remaining value potential. You know, it's all in front of us. The barrels are discovered, but they're all still there waiting to be produced. And not only that, I think beyond Kuda Tasi and Jahal, we see significant upside. The discoveries in the south, Krill and Squilla, are looking very positive on the new reprocessed data, and you would have seen the announcement we made on the early sort of positive view we're taking on those opportunities. Plus, there's a host of what we call near-field tieback opportunities that are low-risk exploration, and each of those have a similar scale to Kuda Tasi and Jahal. So the upside potential here is very important. And interestingly, I can see some questions in the queue around our strategy there. So we'll talk about that, no doubt, later on when we come to question time. So in terms of the development, around the middle of the year, we announced a strategic alliance with SLB or Schlumberger. Now that was a significant partnership. I think for a lot of people took execution risk off the table for the development. SLB is the world's largest oil field services company, 50 billion market cap. And they bring enormous resources to bear on the project, which helps us accelerate to achieve FID early. We're targeting Q2 next year for FID. So right now we have more than 20 engineers working on the design of our subsea production system, and they're in the market on the procurement of our long lead items. And that's resources that Finder alone couldn't ever hope to bring to the project. And what's unique about SLB is they're a one-stop shop. They can take us all the way to first oil. So they're doing the engineering work as part of the FEED now. They can also design the wells, the development wells. They can manage that drilling program, and through their joint venture with Subsea 7, they have access to the heavy lift installation vessels to deploy the subsea production infrastructure. So that's a very important alliance, and I think the importance of that will be seen more and more as the project progresses to first oil. The FPSO, obviously I'll talk a bit about that today, but this is an extraordinary opportunity for the project. We've got what I believe is the best vessel globally in terms of its fit for purpose for the KTJ project. It is what holds the record for the world record for being on the most deployments. So far, it's been on 11 different oil fields, and I'll talk a bit about the implications of that in a moment. But this is a big part of the production infrastructure secured for the project. I think what's probably surprised people is that we're expected to lease the vessel, but we've acquired it outright, 100%, and that has important value and strategic benefits for Finder and the project, which I'll also come to in a moment. So what stands between us and FID now is securing a rig for the development drilling program and funding, and we're making very good progress on those fronts. So let's start with rigs. We're in the market for a semi-sub or drill ship for the development drilling program. We're looking at windows sort of late 2026 or early 2027. And look, we're feeling very positive about rig availability. There's a handful of rigs available in Southeast Asia. Rig rates seem to have come down, and we're being offered very competitive rates. We think there's potential for some capex savings based on the market intel we have. So look, no shortage of rigs. I think we have a very high degree of confidence around finding a rig solution. We have a number of proposals under discussion, and I think we'll be looking to close out those rig discussions early in the new year. So the key piece really, as we see it, is the funding. Now, with the Timor Gap farm-in secured, that locks down 50% of the development capex funding, around $170 million US dollars. So the other half, we're looking at largely a debt-driven solution. And this is a project with very attractive economics that can carry significant leverage. And of course, to maximise the value outcome for shareholders, we're looking at a debt funding solution. We don't need to, and we don't want to give up any more barrels in this project. They're very valuable barrels, and we want to put debt capital to work to maximise the value for shareholders. Now, funding for us as a junior was always considered the main challenge for this project. We had a lot of confidence in the subsurface. So early on, back in mid-January, we opened a data room and we started an early engagement with different debt groups, different sources of funding, and we got very good traction. This is a project with a lot of subsurface data, and a lot of technical work's been done. A lot of economic evaluation has been done to support this debt process. So we've had letters of comfort, indications from various different groups around the availability of debt for the project. But what we've done, just to bring all that together for the last leg, we've appointed Baron Joey, the debt team there, to run a formal process. We want to make sure we get the debt right and we get the most sort of advantageous terms for shareholders. So there's now a formal process that's been initiated that will run through Q1 and looking to get the debt in place, ahead of FID mid-year. So I think with the engagement we've already had ahead of this formal process, we've had positive indications from a number of groups and quite a disparate set of groups from off-takers, from conventional banks, private equity and the like. So we feel very confident around a debt solution and just generally around the project and the remaining steps to FID. So look, I think it's been an extraordinary year, whichever way you look at it. We bought what was a stranded asset in Q3 of last year, and in a year we've created something meaningful here and build a company around this asset. It is our number one priority, and we have a very dedicated team now to execute this project, and a lot of support from the different groups falling in behind us, from SLB, a number of institutions, a score of institutions that came in on the recent equity placement. We're now an institutional stock. We're entered into a new market altogether, and we'll start seeing the benefit of that, I think, in the new year when we start to see the value of this project more fully reflected in the stock price. And I'll talk a bit about how we look at this project in terms of its cash generative potential in a moment. So let's just quickly look at the bones of the deal. $15 million headline value. That's $9 million in scrip and $6 million in cash. $3.5 million up front, which will be paid in the coming days on completion of the transfer of the vessel. Look, as part of this deal, we've really formed a strategic partnership with Amplus Energy. Now they're a sort of midstream group. They have a lot of experience and capability in the management of offshore and operation of offshore production facilities. So that skill set naturally lends itself to the KTJ project. We've been working very closely with Amplus throughout the year, in fact, through the due diligence process. There has been a robust process to understand this vessel and her capabilities and understand the CapEx and modifications and life extension work required to get her in shape for deployment to KTJ. That involved site visits. It involved site visits by our due diligence team, which was led by our COO, Mark Robertson, who has a lot of FPSO experience, along with the ABL group, a marine and shipping group that we've used extensively through the due diligence process. And now, we've done over 400 surveys of all the different systems on board to understand how they work, what modification is required for KTJ. So it's been a robust process, and it's led us to an outcome that we're very happy with. The conclusion was this vessel's a very good fit for the KTJ project. There's a lot less CapEx required and time required to get her into shape for this deployment. And the reason for that, which I'll come to here, is because of the history of this vessel, its many redeployments. It's had a number of shipyard campaigns where it's been reconfigured to meet the requirements of various different fields. It's been, had steel replaced, been maintained. So she was built in 1985, but has undergone, extensive sort of rework, modification since then. I'll give you an example of that. Through the feed process, the engineers have been looking at artificial lift systems. Initially we looked at gas lift, then we looked at ESPs, submersible pumps. This ship has both. And these are very expensive systems, so an expensive part of the CapEx. They take time and money, but we come with ready-built systems here on board the Petrojarl. So that makes it very attractive, and that's one example of the processing systems that we have now and the capabilities we have through the Petrojarl. And I think an early solution here enables the vessel to be integrated into the design of the subsea production system, so that system integrates with the turret system on the FPSO, and that's important in achieving FID in the second quarter of next year. Now, if we look at her performance, her recent performance in the field, her last deployment was at the Atlanta field offshore Brazil. She left that deployment, I think, in the latter part of last year. Now, that was a very challenging project relative to Kuda Tasi and Jahal. It's a deep water project, water depths of around 1.5 kilometres versus only 400 metres at Kuda Tasi and Jahal. And heavy oil. So much more challenging. On that deployment over 6 years, she produced 30 million barrels. Importantly, achieved that with a 98% production uptime. So quite exceptional performance in the field. Now, we won't be asking nearly as much from her on the Kuda Tasi and Jahal deployment. It's mid-depth water and light crude, which is much more mobile. We think that she is very much capable of doing what we need at Kuda Tasi and Jahal. Currently in warm stack in the Canary Islands, crude, and we're going through that survey process and the feed work to integrate the Petrojarl into the design of our subsea production system. So the importance of owning the vessel is significant. What it means is significant OPEX drops out of the equation, drops out of the economic modelling. When we look at what a lease solution would look like, our market intel and quotes we've received at leasing vessels range from at the lower end $60,000 a day to over $200,000 a day around Southeast Asia, which is one of the cheaper operating environments globally. Now, over a 7-year project, we're talking of the order then at the lower end of the range there of $150 million in OPEX that we save. So that just goes on to the bottom line of the project. So significant economic benefits there. What's less obvious is that if you take that OPEX out of the equation, our economic cutoff drops and we can produce that tail end for longer. We produce more oil. And that's around 2 to 3 million barrels of additional production and oil sales. Now, it doesn't sound like a lot, but at $70 oil, we're talking another $150, $200 million of oil sales revenues there. Plus the strategic alignment that we get from owning the vessel. If we want to bring on krill, squilla, for example, or tieback production, we've got control of the vessel to achieve all of that. And what we have seen time and time again, and some local examples, Kitan, Buffalo, both shut in at around 4,000 barrels a day because of issues around negotiating extensions of lease arrangements with the contractors. We just won't have those problems. We'll produce down to something like 1,000 barrels of oil a day economically, and that's a valuable addition to the economics of the project. Look, I put this slide in because it does give you a sense. Well, firstly, it's pretty cool, the engineering software that allows us to do a 3D fly through of the vessel. It allows us to measure pipes for replacement of pipes and all sorts of things. But also, you start to get a sense of just the number of systems on board the vessel that we've acquired here at what I think is a very attractive price. To build this vessel and configure it in this way with these production systems, you're talking over $500 million US dollars and years. It just wouldn't be done for a project of this size. So look, it's a great opportunity. The vessel's an excellent fit and comes very well configured, well suited to what the requirements of the Kuda Tasi and Jahal field. So just to get into some of the benefits of this vessel, it'll allow us to get to FID and first oil quickly, and we're targeting first oil late 2027. And that's the prize here. You start to get a sense of that when you look at that production curve on the right, which is the 3-well development case, the 2C case, the mid case for Kuda Tasi and Jahal. So what you see there on the y-axis on the left-hand side is your barrels of oil per day production, beginning at 25,000 barrels a day, facility constrained to the process handling capacity for oil on the Petrojarl, and then you see a natural decline curve. Now, if you look at the x-axis there, that's years. Within 2 years, we're forecast to produce around 15 million barrels of oil. Now that's nearly at $65 oil. That's nearly $1 billion US dollars in revenue in the first 2 years, and we're targeting 2028, 29 for those first 2 years of production. So that's what we're heading towards here. That's why this acceleration project is so important to us, and that's what this vessel unlocks. So it's quite a powerful moment for the project. As I say, if there was any doubt, I think this has put that doubt to rest. We now have this ship on our balance sheet. We will have on completion in the coming days. So I've been through the sort of OPEX and CAPEX savings. I've mentioned the Amplus partnership. I think we've discussed the production systems. So that we did undertake a global target asset survey. We looked at every redeployment candidate globally and came down to a short list. We got to know Amplus very well through the due diligence process, and we found them to be a very capable group that could really bring something to the project. And I think through that engagement, through that process, we started to build a relationship that led to more of a strategic partnership. It changed the nature of the discussion altogether. From originally it was a lease concept under discussion into full ownership with Finder on a script-based deal. Amplus they're a very sophisticated midstream group, and they understand the value of this project, and naturally that led them to a solution where they took a piece of the ownership of the project indirectly through owning shares in Finder. So I think the deal made sense for both of us, and I think it's unlocked a lot of value in this project doing it the way we've done it. So look, it's been a great year. Obviously, shareholders have benefited greatly as we've hit these project milestones rapidly. We've seen a revaluation of the shares, and I think we would be one of the top performing energy stocks on ASX this year, which is great. But what's really exciting is that this is just the beginning. when we look forward now to FID and beyond, we've now broken the back of the project. All of the steps that have been taken, these milestones in the last 12 months, have sort of de-risked the next steps, particularly the debt funding. For example, you're having TG obviously funding funding half the development capex, creates alignment with the government, also solves half the funding solution, which helps facilitate the debt. Having SLB fly their banner over the project in the way we have with their collaborative contracting model, that's a big validation of the project. SLB have only done this a handful of times in their 100-year history. It's quite a rare and unique thing to be working like this with SLB. And that gives great confidence to the debt groups we're talking to about our ability to deliver and execute this project. But looking forward, obviously we'll complete the Petrojarl acquisition in the coming days. Early in the new year, we're hoping to secure the rig, and that'll give us visibility on the timing of the development drilling program. There'll be updates on the production forecasts based on the upgrade in the resource estimates for Kuda Tasi and Jahal announced recently. FEED will complete, I expect, early in the new year, and we'll go through the preparation of the field development plan, which is already underway, but that'll be submitted for approval in the new year. The debt funding will look to complete the formal process that we're now embarking on around Q2, ahead of FID towards the end of Q2. And at FID we book 2P reserves. We're currently carrying a 2C contingent resource for Kuda Tasi and Jahal, which might seem a bit strange to some. The oil's proven, technically. The only thing between us and booking it as a 2P reserve is an intention to develop, and that rests on funding. So once we secure the funding solution, we reach FID and book 2P reserves, and we see that as shifting into a different sort of value equation in terms of how the market will price these barrels and the project. And then looking in parallel with all of that, now that we've broken the back of the Kuda Tasi and Jahal project challenges, we're now starting to look and think a lot more about the upside opportunity in the PSC, the scale of that opportunity. These are multiples of Kuda Tasi and Jahal, each one of them, and we like PSC regimes. You're strongly incentivised to keep drilling. You can cost recover your wells against Kuda Tasi and Jahal production, and that risk-reward equation becomes very attractive in those circumstances. So we want to get after that. We want to get after Krill and Squilla. We see updip potential there. They look very interesting on the new mapping. We announced some positive early results with that mapping on the new repro data showing an increase in the GRV, gross rock volume, of those reservoirs, and multiple tieback exploration prospects around the north and the south of the PSC, where we see the development hubs forming up. So our priorities, of course, continue to be achieving FID by mid-2026, and that pathway has been significantly de-risked by the events over the past 12 months, and of course achieving first oil by late 2027. So I'll just finish off. Obviously what you can see here is the re-rate of the stock throughout the course of the year, from that series of milestones. Our market cap now in the sort of 150 to 200 million range. Our cash position is sufficient now to see us through to FID and execute that acceleration program. Still, I think when relative to our peers, following completion of tranche 1 of the recent equity raise, we maintain that tight capital structure, which gives shareholders a lot of leverage to success and news flow. But look, it's fantastic year for everyone. I think transformative year for the company, but I think very well placed both financially and in an operational sense to deliver the project and create significant value in the coming year ahead. So with that, look, I'd like to sort of open up for questions, and I can see a number of questions. I'll hand over to Matt Warner to read out those questions.
Sure, thanks, Damon. There's a couple around, and we've touched on a few of these. The current status of the debt funding, and where is that looking like it will come from?
So we've got overlapping sources of funds. We've had very good engagement, I think, from different groups, particularly. I would say the commodities traders. This is a light sweet crude, and there's a lot of interest in the offtake, and there's groups amongst those that are looking at coming in on the debt, or even could fund the entirety of the debt as part of an offtake arrangement. So they're one possible source of funding. We engage with the Nordic bond market. We're looking at conventional bank, RBL, reserves-based lending, as well as private equity debt solutions. So look, I think we're now at the point where we want to get some advice on getting the debt structure right and finalising the process. And we've appointed Barrenjoey to that end. So I think watch that space. We're actively starting to engage with the debt market through this formal process now to bring it all home. But I think we're very confident that we'll find a debt solution for the remainder, if not the majority of the remaining capital required to develop the project.
Okay. We talked about the reduction, a extension to field life, if you like, and associated OPEX savings. So where do you see that sit? We talked about $150 million reduction in cost. So over the sort of project field life, where do you see that as on a per barrel basis? Is one of the questions.
Yeah, so using that number, just some back of the envelope maths, $150 million over the 25 million barrel recoverable sort of 2C case. You're talking about $6 a barrel in OPEX savings there, plus some incremental production that I mentioned also. The two other discoveries, Krill and Squill, obviously provide a lot of upside and potential for the project and a good further deployment of the vessel. So there's a resource update that's been planned. When can we expect to see that? Yeah, so the interpretation work's ongoing on the new ICANN 3D reprocess data. That's been scheduled to complete during Q2 next year. So we did announce sort of our early views based on quick interpretation of that data. We saw massive uplift in the quality of the data in the southern half of the block, where we've got reef build-ups that interferes with our velocity modelling and our seismic imaging. The high-end sort of modern reprocessing flows we're using now can resolve those uncertainties, gives us much better data, and that has improved the mapping of Krill and Squilla in particular. So look out for that. We're not sure what the result will be, but it's looking very positive at this stage.
And just a question around offtake and what that might look like and the timing of that, and if any of those arrangements might occur pretty soon into the new year.
Yeah, if offtake's tied to debt, it'll be all sort of stitched up with an offtaker pretty soon through those debt arrangements. Otherwise, oil sales, it's not it's not like gas where you enter into long-term contracts. It sells on a spot market. This crude will be priced relative to Brent, either at a premium or discount, depending on what the refineries need at the time. We haven't sort of looked at hedging, but perhaps that discussion's coming at us as we sort of engage more deeply with the banks on the debt funding. So look, everyone wants light sweet crude. It can be used to blend with the heavier Saudi crudes for petroleum, or this product can be sold directly into high-end petrochemical markets, plastics and the like. So it's likely to trade at a premium. I think this product will sell, no question about that. What we're considering now is do we pre-sell the product, or do we have offtake arrangements pre-agreed as part of the debt solution? And the work's ongoing in that regard. Thank you.
Company's working really hard on the feed project and the integration now, and we have been for a while, of the vessel into that feed work. So how's that going from a timeline perspective?
Look, it's cracking on. I mean, SLB are throwing everything at this. I think one thing I'm pleased to say with SLB is they've really listened and understood that this project's all around cost and speed, and they've resourced up. We have an integrated team where they're working very effectively together, and the target is for completion of feed in Q1 next year. That will include the integration of the FPSO, and that work has begun and has started in earnest. So that will all come together in Q1 to allow for the finalisation of the field development plan and submission of the field development plan to get us to FID in Q2.
Just a question on the vessel itself and the extent of modifications or upgrades that might be required on the top side. So we talked to its numerous deep redeployments and so on. So I think it might be just worth touching on that question.
Yeah, look, all the vessels we looked at, whether they're lease or acquisition or farming type deals, every vessel needs modification, and that's just par for the course when you're talking redeployment to make it meet the requirements of the Kuda Tasi field. This vessel needs a lot less capex, a lot less modification work, because it's configured with different specs for different fields that lend itself very well towards sort of modification and adaptation for what we need. So it's within our what we've been carrying as our capex estimates for the development. So we can do it cheaper and quicker with this vessel than with any other vessel we've looked at through the global evaluation process that we've undertaken.
Just a question around the further exploration potential and its ability to be incorporated into the debt funding, given there's significant upside there, and whether that can fit into the debt funding process at all.
Yeah, look, that's an interesting question. Look, naturally we've been focused on funding Kuda Tasi and Jahal because that obviously was the nut we had to crack to unlock that cash flow from production there. Now that we feel that's under control, we're starting to think a lot more about a strategy and a timeline around how we'll unlock that potential. And we want to go after it. We just see enormous value there. There's a lot more to do in this PSC. There's a lot of follow-up potential. In terms of the exploration, this Lemon Area High region has enjoyed very high rate of success. The strike rate on genuine exploration wells is 50%. We've had 34 wells drilled in the area, 17 discoveries. So the traps invariably, or 50% of the time or more, contain hydrocarbons. The question is, do you have commercial quantities of hydrocarbons in those traps? So because of the PSC structure, as I outlined earlier, there's a strong incentive to keep drilling here, and that's, we want to go about that. Whether that will form part of the debt funding, or funding solution, which would allow us potentially to drill some exploration or appraisal wells as part of the development well drilling program. I think too early to make a call there, but that's something that we're starting to think about. And we'll just see how these discussions take shape with the debt groups. The economics will be compelling. I mean, these are, with the vessel in place, the infrastructure in place, the tieback barrels, very high margin barrels. So it will make a lot of sense to pursue this, and that's something that we're starting to work on now.
Well, I think also where you will be, with that exploration, what will allow you to do is the significant cash flows that you'll be generating outside of any debt funding will really allow you to get after that. So that the debt will be quite focused on the development project itself, but the cash flows you're generating will really allow you to kick on and get after that.
Just to elaborate on that, to drill an exploration well here, it is cheaper than to complete development wells that we're looking at now. You're probably looking around $20 million to drill a well. That's a week or so of production at Kuda Tasi and Jahal. So once you're in production, certainly we'd get after it. I think what we're thinking about now is can we even get after it earlier than that, which is an interesting idea.
Last couple, and we might just zoom from Timor to the UK now. And there's a couple of questions coming in around P2610 and the recent discovery by Equinor in an adjacent permit, and the implications that has for Loffen and Langman wells and that project in the UK. So a bit of a deviation from Timor, but a good question.
Thanks for the question. So look, firstly, congratulations to Equinor and Aker BP on 2 discoveries in just on the Norway side of the median line between Norway and UK. Equinor is now the biggest energy gas supplier in Europe, and is drilling hundreds of exploration wells over the next decade. I mean, they're aggressively going about feeding Europe's energy demand, and to do that, they're intensively drilling structures around existing infrastructure in Norway. Our P2610 licence is right on the Norwegian border, and there's no shortage of examples of cross-border developments there where the gas is taken east into Norway and accesses European markets that way. In P2610, we have a significant structure there, 700 Bs of gas and condensate at Boaz. The Loffman discovery is very close to that, just up dip, and obviously there's a very positive development. We don't have access to the well data from these 2 discovery wells, but obviously demonstrates that, or continues to demonstrate that structural traps in this area invariably contain oil, gas. So look, this is very exciting development for Boaz, and I think Boaz fits squarely into the theme that Equinor is pursuing there to tie back new gas discoveries into its existing infrastructure. So I think this is positive. It's positive in the sense that it will encourage Equinor to continue to drill around the greater Sleipner area, and I think very positive outcome for our JV. It's always a great thing when nearby wells come in. It's a very capital light way of de-risking your exploration opportunities. So great news for Finder there.
Look, that's probably all the questions we have for this morning. So I'll let you wrap that up, Damon, on what's been an exciting week and a very exciting year for the company, and we can wrap it up from there.
Yeah, thanks, Matty. Look, I think what a year for Finder. I'd really like to thank everyone, all our shareholders, for the support they've shown. It's been a journey, but I really feel like we've been able to deliver on our promises this year, in rapid succession. These have been major project milestones, and it's great to see this project moving forward with such momentum to FID. For the team here, this project's a once in a career opportunity. It's unique. It's an extraordinary project, and it's exciting to be a part of it. It's exciting for us to come to work every day, and I think exciting for shareholders to participate. And we're seeing the rewards come, and I think we're really well placed in the new year to continue to deliver that rapid progress and continue to deliver the value creation for shareholders. So thank you, and thank you for participating in the webinar today, and thank you for, I think, some very interesting and broad questions. And Merry Christmas to everyone. Thank you.